Allowance for doubtful accounts, used to estimate uncollectible credit sales. It is a contra account presented as a negative number, credit, in the asset section of the balance sheet. The allowance is increased along with bad debt expense if more customers are expected to not pay amounts due. Allowance for doubtful accounts is going to be a part of our asset side of the accounting equation. However, being a contra asset is actually going to reduce the value of a regular asset. So we have regular AR. This is accounts receivable. Without understanding accounts receivable, you cannot understand allowance for doubtful accounts. Accounts receivable is a function of when a sale is made. So if I sell something for 100K, my AR will go up 100K, and so will my sales revenue. So income statement equals revenue minus expense. So revenue goes up, accounts receivable goes up. This concept of receivables is what other people owe us in business. As a CPA, people owe me money. And I want to get paid. But here's the thing. I keep track of my own receivables, how much people owe me. And how it works on the accrual basis of accounting is revenue comes in, even if it doesn't come in the form of cash. Revenue and then accounts receivable. In my business is when services are performed. So it's pretty obvious, but it's not like someone talks to me and I just grab their ATM card or get their PayPal account or whatever across the table. It first goes into accounts receivable. Now, the purpose of the allowance is that of this $100,000, maybe it's not all going to be collected. That is the key. So, all things being equal, having this revenue of 100 and accounts receivable of 100. Let's say this is many clients. Someone is not going to pay. It's just going to happen eventually. And now we're just starting in this business. So, in order to account for the fact that someone's not going to pay, let's say there's one deadbeat for $1,000 and they're just never going to pay. So at some point in time, we need to show that accounts receivable is not really 100. It's actually minus that estimated bad debt, estimation of non-collection, referred to as the allowance for doubtful, meaning I don't know if we'll collect it, doubtful accounts. So the net of the two, the difference, what accounts receivable is really valued at is more like $99,000. And everything in accounting having an opposite side. This $1,000 will be an expense from revenue in that particular period. So this can go up and down and be adjusted, typically increasing as accounts receivable increases. So now without anything else, we have knocked down our profit by 1,000. Establishing allowance for doubtful account is kind of like an audit procedure. It's also internal with the company. And the question is, hey, are these receivables, are these good? Or are they kind of bad and rotten? So a lot of incredibly huge and horrible accounting scandals have come to not having proper allowance for doubtful accounts. Under accrual accounting, we book revenue, when earned. Now who's to say when and how is earned? GAAP's going to have its rules, but it might be shipped, it might be services performed or whatever, but accounts receivable is going to have the sales that are not yet collected, and the allowance is going to reduce that. And it will also show that the company is less profitable had there been no allowance for doubtful accounts. This is a Contra asset, meaning the regular rules of debits and credits are actually flipped. So it's increased with a credit and decreased with a debit, much like accumulated depreciation and accumulated amortization. So remember, this is Contra because it's reducing the asset that is accounts receivable. So they're both related, friend and foe, let's say, accounts receivable and allowance for doubtful accounts, to show how much money we estimate that the company can actually collect. This has been Allowance for Doubtful Accounts, accountingplay.com. Thanks.